So basically, in terms of the topic, it's managing downside risk in volatile times. Now, if you just take it on face value, things like volatility is not a bad thing. In fact, if you're an active guy, volatility is actually a good thing. So typically, what we try and do as active managers is we turn risk into return. So if markets are choppy and volatile, it creates opportunity for active managers, and you would say that's pretty good. And that's basically what a lot of active managers attempt to do. But if you think about, the world is not that easy. And I think we all feel uneasy about how we're going to make money for our members, our clients in the current world. So instead of volatility, I'd say the world is probably more uncertain. And if you look at measures of volatility, for example, in equity markets, they haven't been that choppy of late. Sure, we had Brexit, but generally over the last 4 years or so, it's been a pretty calm world. If you look at the macro variables like economic growth, the last 3 or 4 years, it's been pretty stable as well. So volatility in a lot of things isn't that big, but the world seems to be getting more and more uncertain. If you think about what's happened post the GFC the last, 7 or 8 years or so, you've seen more and more versions of economic stimulus, of monetary policy, which just keeps getting more and more extreme. So you look at the US, we're talking about unwinding Fed policy. It seems to be a stop-start process that's taken a long, long time. The European stuff we thought was kind of solved about 4 or 5 years ago, but it's still bubbling away in the background. Add to that, we've had negative interest rates in Japan. Japanese policy, again, seems to be getting more and more extreme. Right, we had Brexit the other day, but everywhere you look, you just see piles and piles of uncertainty. We seem to be climbing in this stepladder of uncertainty, and at any time, any of these things can shuffle up. The big one, of course, for Australia is China, and we've talked about China off and on. I don't think anyone fully understands where China is going to end up. We kind of hope all these things hold together. And I think that's where the world is. Most of us in the institutional world think, the more troublesome the world becomes, the more extreme these policy moves become to try and combat them. The worrying thing for all of us in this uncertain world is that central banks are kind of running out of ammo. And we've seen it with negative rates. It had a troubling effect on a range of economies, and we're not certain whether others would want to step across the line. So you've got a situation where growth is quite weak. Central banks haven't been able to reload, and they're saying, well, we've probably done just about as much as we can do. So the world, in my mind, is very uncertain, but we have patches where things are pretty stable. Something happens, then we get these outbursts of volatility. So, as someone, managing a large chunk of money, a bunch of diversified portfolios, what do you do? So the first thing is you think about, the client objectives. And I would say in the current world, you've got to say, well, are the objectives appropriate for how I think the world is today? And in a lot of cases, the clients that we've spoken to, pretty much all of them at QIC have pondered, are we going to generate the returns we're hoping for? If you're running, a fairly conservative fund where you're relying on income and you can't handle any volatility, you want stable capital, the answer is almost certainly no. You're going to struggle to generate your income out of those kinds of assets. So you've got a couple of choices. You can push up the risk spectrum, which is very uneasy. And as I said, if you can't handle any capital volatility, it's a tough thing to do. Or you admit the fact that you're just not going to meet your budgets. And that's got flow-on effects for businesses and size of staff and payrolls and how you run things. So we've seen a number of our clients, particularly up in Queensland, have said, really, this is a tough world and we need to change the objectives. We need to change the way we do our business. For the more risk-seeking funds, if the world pans out the way we think it will, you will probably be okay. And, they're not comforting words, but the words are probably be okay. We're generally keeping, the objectives around about where we've had them CPI plus 3 or 4. Lower CPI helps us out a little bit. But, across the board, it's a tough world out there to meet your objectives. Of course, the clients say, we just want you to generate 8% return with no volatility and charge us low fees, which is a very, very hard thing to do. With those risky funds, you've got to think about what are the risk factors driving, these portfolios, and typically it is the equity risk. And you've got to think long and hard about, do you want that level of equity risk or don't you? If you don't like it, there are some things you can potentially do about it. If you I'll jump to the next slide. So to be very specific in terms of managing volatility, there's 2 broad things you can do. The first one is to think strategically, how am I going to handle the fund? And one thing you can do is say, this world is just tough and it's uncertain. And there's a number of fairly high-profile funds have said, in this tough, uncertain world, we don't quite know where the world's going to end up. We know that bonds are very, very expensive on a range of metrics. We know that most things don't look that attractive either. We will have a lower risk portfolio, we will sell stuff and we will own cash. That's one thing you can do. We haven't done that with the funds that I manage. We've said we want to try and meet the objectives of CPI plus 3 or 4, so we've got to keep the risk there. But the things that we've done is we've moved away from equities into some of the alternatives. So things like infrastructure, private equity, real estate, diversified alternatives, catastrophe bonds, all these things have got some benefits there. But again, you need to understand that often there is a big interest rate factor driving the returns on some of these things. You need to be careful about what you're getting. There is also an element of growth risk or equity risk in them as well. So, you need to be sensible at how you try and diversify away from equity risk if that's what you choose to do. Other things that we've done is we've looked at, being a little bit more dynamic with how we run the portfolios. So I'm like an old TAA, DAA guy for the last 20 years, so of course I'm going to say TAA isn't a bad thing. But, it's become a harder world because you just can't look at the averages over the last 20 years and say real bond yields average 2.8%, they're going to revert back there. It's unlikely in the foreseeable future they move back to those levels. So we've thought strategically about what is the right benchmark or what is the right valuation metrics in this new, difficult, uncertain world. And typically they are lower. So bonds, it is reasonably straightforward. The challenge you've got then is you want some premium above bonds for, the risky assets. The question is, how big ought that premium be? So if it all gets dragged down with bond yields being reset lower, so you still get like a 3 or 4% equity risk premium, but off a lower bond base, it means that things can go up. We don't think that's going to happen because things are tricky out there in the growth world. But it's harder to set where the risk level for these these more volatile assets sort of be in the TAA world. Other things that you can do is you can think about hedging your portfolio. You can hedge the equity risk directly, and we've seen some clients across the board looking for tail protection, so run a bunch of option programs, put options and so on. Again, you need to manage these things in a fairly dynamic way because, as we know, hedging typically costs you money. But you've got to weigh that up against the opportunity costs of saying, well, if I sell my equities and stick my money in cash, I've got a certain return, but it's 1.5%. I can't live on 1.5%, so I'll take some equity risk, but then it's sensible to spend some of that return back to give yourself some tail protection as well. Other things that are out there, currency was a good thing when it was up at parity. We saw it slide down to, mid-70s, potentially can go a bit further, but having more foreign currency in your portfolio, will potentially hedge you if the world turns ugly as well. The problem with that is obviously if you run a fully hedged foreign currency program, you're going to pick up about 1.5%. So it's actually costing you some money as well. So what I'm saying in hedging, there are no free rides, but there are some legitimate ways to take the risk out of these portfolios through a hedging program. Finally, I just want to say, look, we like to be systematic and we like to have a game plan. So Brexit's an example where the world turned ugly. We were on the wrong side of Brexit. We still ended up making money because, again, we adjust how we trade these positions with a range of scenarios. But, bigger picture, as I said, the world is certainly more uncertain and we just can't see a lot of these uncertainties getting resolved anytime soon. I think the world, as I said a number of times, will pan out okay. But if it doesn't pan out okay, you probably need to think about, what measures or what layers of protection you might put in your portfolio, both strategically and dynamically, so that if the world doesn't pan out as well as we might hope it would. Along the way, there's going to be choppy, volatile times where you can probably make some money as well, again, if you've got a game plan, a strategy to execute. The last slide is the disclaimer, being back a commercial fund. As you can see, it's probably the longest part of my presentation, but I'll pass on to the next speaker.
Thanks very much for inviting me here to to speak on this topic. In a world of manipulated markets where you've got bubble pricing probably existing in bonds and 12 trillion of cash sloshing around from central banks, this is a very apt topic. And it's particularly relevant in pre and post-retirement investing when large losses that come from markets are unable to be replaced by future contributions. So my approach to this, as you can see, is to combine two of the topics that we talked about earlier on, diversification and alternative assets. This takes advantage of both the long-term approach that superannuation funds have and also the free lunch of portfolio diversification. So this is what I'm going to talk about, a bit about the benefits. What do I mean by alternative assets and strategies? Because they're very broad in my context. Demonstrate some numbers that we've seen for long-term correlations and talk about some structural advantages. So first of all, let's remind us about the benefits of diversification. Use the simple two-stock example, something you've all been very familiar with, an umbrella maker and a suntan lotion or sunscreen lotion company. We've got a two-stock portfolio here. Both of those companies that you can invest in have an expected return of 7% and a risk as defined by standard deviation of 12%. And because they both do well in different times, different types of times, they've got a correlation of 0. So in a portfolio context, you can either own one or the other with an expected return of 7, a risk of 12, and a risk-adjusted return in isolation of 0.58, or you can have the free benefit, the free lunch, the benefit of diversification, and have a 50-50 portfolio of these two stocks. Your expected return is still 7 in that environment, but with the free lunch, you get a risk that's 8.5%, i.e. lower than both of those two stocks. And you get more than a 40% increase in portfolio risk-adjusted return, which it's like a free lunch really. It enables you to basically take more risk elsewhere, such as equities, or enables you to have a portfolio that has a lower risk overall. So in investing, I want to take advantage of this diversification benefit to the maximum because it's a strength and a tool that you have in your kit book, and also use a longer term view. So in order to do that, I'm going to invest into alternative assets. So by alternative assets and strategies, what I mean are anything that's non-listed equities and bonds, so a very large, diverse bunch of things. Includes infrastructure, real assets, hedge funds, private credit, property, commodities. Now, I'm doing this on an opportunistic basis, so I'm not always invested in every one of these areas. The really important thing is to do this dynamically and opportunistically, but to do it over a reasonable long time period. These assets will take a reasonable long amount of time to get into and get out of. So in order to do this, what I do is take the existing portfolio into account and find things that A, complement it, and B, are more attractive at that time. So what fits well in one portfolio might not be so complementary in another. And it's certainly not a fill-the-buckets approach. It's certainly not one where you're putting something into your strategic asset allocation, pouring money in, filling that bucket up, and then repeating. In fact, it's quite the opposite. It's like looking for nuggets of gold that fit well with the existing portfolio at a point in time, and then when they run off, by then you don't necessarily replace them. So moving on, you can see the types of strategies that I've looked at and invested in sort of over the years, over the last 8 to 9 years of doing this. So moving on, these shows you some of the correlation numbers over long periods of time. This slide is put together with the help of Standard Life and some of the other data services. It shows for the 12 years of data from 2004 to 2016 a long-term average correlation for a variety of asset classes or asset strategies. And I've used a traffic light system here. Red is bad for diversification, green is good for diversification with low correlation. So this just shows you a flavour of some of the things. And if you look at the bottom line representing farmland, you can see there that nearly all those dots are green, showing a good long-term diversification effect. This is obviously a backward-looking thing, not necessarily forward-looking. If you also look at the second column in from the left called absolute return, that's actually a portfolio that I've put together over the years of various strategies. It's not your average hedge fund portfolio, and again, fairly low beta, diversifying portfolio. It's got lots of green, so it's also good to use for diversification. So we know that diversification is that piece of magic, that free lunch that you can invest in. My belief is you should do it as often as you can, and we also know that some assets are lowly correlated with mainstream asset classes over the long run. But there are also some structural advantage in private assets and alternative assets. Most of these are housed in closed-ended vehicles, and I think because investors' money are all locked up together for a certain time, they offer some structural advantages as well. One of the huge advantages here is that it eliminates market timing by investors. So the allocator no longer has to choose when to go into that aircraft leasing fund or that private credit mezzanine fund in Europe. That's decided by what you hope, as you've employed them as a skilled manager. Also, because there's no asset liability mismatch, the fund or the manager can use leverage judiciously with no risk of repricing and refinancing. Thirdly, there's no forced exits, which really basically encourages good performance when markets are down or when investors are getting flighty or trigger happy. It means the manager can be patient and actually invest against the trend to buy things when they're cheap. I think that behaviour that gets encouraged is a real plus for these types of assets. Performance fees are only paid on sales and only above a minimum hurdle. Most of them are around 8%, somewhere between 6 and 8%. That number hasn't gone down, despite rates going down from 5 to 0. So, there's as I say to my trustees, well, even if it's a disaster for the manager, we've got 8%, so it's not such a bad outcome, really. And also the alignment of interest. Basically, managers' money is invested alongside investors. They're also locked up as well. They feel the pain. It's not that thing called other people's money, where so many people manage money but manage their own differently. There's also another couple of advantages that I wanted to talk about. One was that in private markets, people use money-weighted returns to measure success, and that's, of course, what the investor achieves. The industry, as you know, with alpha and beta and separation, uses time-weighted returns. But in this case, the managers here get invested only when they call money and return money, only when it seems attractive. And this gives a really powerful signal back to investors, because they'll only call money. They could be patient and not call any money for 3 years. They'll only call money when they see a really good opportunity, and they'll only send it back when they think that it's a good time to realise the asset. That whole signalling mechanism gives us a lot more information and really helps, I think, for these investments. And the other thing is, of course, you can build by design capital preservation into the portfolio. You don't have to, because you can have very growthy venture capital, and you can have lots of things in the alternative assets. But by design, I like to build things in that have a gap up to fair value, security in lending, security in asset base, or absolute return functions, so that I've built in by design some protection. Okay, there are lots of challenges in alternative assets. As we all know, I've identified some here. I'll just talk about the first one of these, and then maybe I'm sure there'll be questions we can come back to some more later. So you identifying strategies and funds opportunistically is not the easiest thing to do, particularly when your staff are organised into silos and are asset class specialists. It's also hard to do sitting in Collins Street or in Sydney or other capital cities, because in my experience you need people with a breadth of experience in these asset classes, and you need to be out there, because many managers simply just don't travel to Australia, particularly at the smaller ends of funds. I'll leave the rest, but you can see there's negotiation and implementation is quite significant, and you certainly need to do operational due diligence. The message is that even though you start with a free lunch, you start with diversification, success is not always guaranteed. You need to be on the ball in implementation. So in summary, you should start with the free lunch, which is diversification. You should be opportunistic and diverse to prevent silo asset class thinking. It allows you to look for the strategies that fall between the cracks of asset classes, so fewer people are looking at them. It allows you to also move the odds your way, to take advantage of a long-term time horizon, to harvest illiquidity premia, to eliminate market timing, because this is done for you by the manager, and to use alignments of interest where managers have their own monies working alongside you. And you're also measured on a money-weighted rate of return like your investors are. So even though there are significant challenges and you need skilled implementation, you can also build in downside protection, which is really valuable in pre- and post-retirement, where, remember, dollar cost averaging works in reverse in the decumulation phase. Members can't afford to have those losses and they no longer have contributions. So anyway, thanks for your attention. I look forward to discussing more of these strategies in the Q&A.
Thank you, Bev and Jim. We are moving from going quite broad into a narrow focus into one asset class, equities. And we want to focus on equities because APRA keeps telling us when they release their quarterly stats that on average 40 or 45% of our capital is actually tied up in listed equities. So it is important to think not just in broad terms about the impact of volatility and downside risk, but also its impact on a really important asset class in our overall portfolio like equities. So I want to cover three things today. I want us to think about how well we really understand the damage that volatility can do to our equity portfolios. I then want to have a look at how we're currently responding to that and give you my assessment of how well these responses are working. And then just give you very quickly at the end one example of how innovation can be used, I think, to solve the problems that volatility creates in an equity portfolio in a better way. So let me start with an observation about this industry dialogue about volatility. The numbers in the room tell us that this is a really important topical issue and it can keep trustees awake at night and members for that matter. But it seems to me that when you put your ear to the conversation around volatility in equities, we're really talking about how uncertain things become when a member's trying to plan for retirement. We're worried about volatility and ups and downs in a member's balance undermining the member's confidence in the fund. And we're worried about something that actually happened during the GFC, and that is members panicking just at the wrong time and switching out of equities and other growth assets. And all of that's really important, but what it does miss is the fact that the journey problem, the problem of this sort of rough ride that volatility creates for funds and members is only part of the problem. I actually think that volatility is a two-dimensional problem, and I want to set that out here. I talk about volatility in equities as certainly being a journey problem in terms of that rough ride, but it also being a destination problem. And by that I mean we still have this core mission where we're trying to build retirement savings and close that retirement savings gap for our members. Now, what we know about volatility is that there's this concept of variance strain, and that is that if you sort of plot two investment strategies and they have the same arithmetic return at the end of a period, and all you do is introduce volatility into one portfolio and you give them the same end arithmetic returns, you find something really interesting and strange, and that is that on a geometric or compounding basis, which is the way that we calculate returns through time, you actually see that the volatile portfolio is actually down relative to the no-vol portfolio. And some of you might have come across that concept that overall the growth in a portfolio is very approximately equal to the average arithmetic return of the portfolio, less about half the volatility. So what I'm saying is that there's this variance strain or volatility drag on returns that actually eats into members' imbalances. And so when we think about volatility, we have to remember that it's not just a journey problem in terms of how we smooth that rough ride. We actually have to find a way to reduce volatility so that we don't have that variance strain, but also reduce it in a way that doesn't cost us so much that we have the variance strain by another name. And another way of saying that is that it's by focusing on the journey aspect of volatility, we can just very casually trade off in returns for the member. We can just decide that we have to choose between one or the other, and we're saying in this case that the journey problem is a more important one for us to solve than the destination problem. Now, there are really unpalatable choices there and difficult choices to make. What we're really doing when we're saying that as a fund is we're saying that sequencing risk is more important to solve than longevity risk. We're saying that we are really worried about benchmark relative risk if we depart too far from that, and also peer risk. So there are some really difficult issues, and my concern is that we can't really solve those issues probably if we don't sort of take a wide-angle lens view of volatility and understand that a really fully formed solution has to be one that solves both the journey and the destination for the member. So what I've done here is I've looked at sort of the typical responses to volatility in an equity portfolio that I've seen, and I've used something that came out in the Financial Systems Inquiry report, which I call the SIPA triangle of needs. And I know that that's sort of a retirement solution, but let's use it for the sake of this illustration. That Financial Systems Inquiry report suggested that at least a SIPA solution should have 3 key features. It should have high income underpinned by some growth, it should have flexibility, and it should have risk management. So let's look at the way that we're currently thinking about solving the volatility problem and measuring them against those 3 objectives. And what we find here is that sort of the first 2, which are around risk-adjusted returns and some kind of slightly more innate defensive characteristics in our equity portfolio, really just sort of don't actually really solve the volatility problem. They're sort of giving us transparency, or they're tinkering around the edges. So we can't really give them a tick on all of those 3 boxes, and they certainly fail on the risk management side, arguably. The third option there is de-risking, and that's something that we've all thought about it as a response to volatility, and that's simply just taking money out of equities and putting it into a safer asset class. And of course the issue with that is that you do get the volatility and the risk characteristics that you want. You can keep the flexibility, but you're really sacrificing a lot by giving up the equity risk premium. So again, you're not getting sort of a complete solution there in terms of the way the Murray report talked about SIPA solutions. Let's now have a look at the 3 solutions I've put sort of in the next column, and these are the really sophisticated responses we're starting to see about equity volatility. And that's something that Jim talked about, which is actually buying some really targeted downside protection or tail risk protection, or a true volatility dampening strategy where you're long a volatility instrument that actually moves in an inverse correlated sense to your underlying equity portfolio. Now, all of those sound like great volatility solutions, and they do get a big tick, at least in my book, on risk management. They can suffer with flexibility in terms of the derivative instruments that you use. But the other big problem, again, is that they're really costly, and this is also something that that Jim alluded to. And so you give up so much in terms of paying for that protection. That goes back to the problem that I raised before, that you're solving the journey problem, but you're really actually undermining the member's destination or sacrificing a lot in terms of their end returns. So none of those, in my book, are really complete solutions. They're certainly better than nothing, but I wonder if the industry can do better. This is a really important problem to solve. And so here's one way that I think the industry can do better, and it's around using a bit of innovation. So those really sophisticated responses to volatility are around being long the risk, long the volatility, and then just buying expensive protection. And here's an example of how you can do the reverse. You can actually physically de-risk, so actually take some risk off the table, and then if you think protection's a really costly exercise, why not be on the sell side of that and harvest some very risk premiums? So I have some very detailed research on that shows that it has actually some great characteristics. The thing that most excites me, and I'm sure this is not the only solution, is that it shows that you can actually put a tick in all of those three triangle points. So you can actually do better, I think, than all of the current solutions that are out there. So I want to finish by a bit of an exhortation to the industry that we do really want to set very high standards in terms of how we solve the volatility problem. One interesting thing that came out of the Productivity Commission's draft report that was published about 4 weeks ago was that the observation that we all know actually, but it was a good reminder, that the retirement landscape for superannuation is really sparsely populated. And I interpret that as it giving us a licence to innovate. We really shouldn't have a concept of peer risk because we don't really have a peer universe, a proper peer universe in the retirement space. So I say we should go for it. My view is that equities need to continue to do a lot of the heavy lifting because of the lower for longer environment and longevity issues. What I've demonstrated here is that it's really important for us to take a wide angle lens view of volatility and appreciate that there's more than one dimension of this problem to solve. And I would suggest that, through innovation, you certainly want to just casually trade. You want to avoid just trading off members' returns. And one really good way to do that is to avoid the costliness of some of the targeted protection solutions that are out there. All fodder for a good discussion now, I think. Thank you.
But in terms of, some of the strategies that we've discussed today, Jim's talked about strategic and dynamic approaches, but the need to have a plan. Bev, I think you've been, obviously looking at the weather in Cairns with some umbrellas and sunscreen, hedge either way. But it's all about, careful implementation and that you can actually use some alternatives that you might not normally think about. And then Raewyn was talking to us about the journey and the destination and some innovative solutions there. Just, Raewyn, over the last, decades, we've seen sustained periods where markets kind of go up and you'll get an extended bull run. But some of these strategies where you're using derivatives, there's obviously a price and you're not capturing the full upside potential. Don't you then run the risk that you're, as a fund, you're going to underperform your peers because you're not capturing the full upside and you're protecting on the downside though?
Yeah, and it's sort of one of the obvious things to think about if you're going down the route of defensive equity, is that sort of the way they're constructed means that you will outperform on the downside, but you will underperform on the upside. And because that sort of raises exactly that question, which is why I wanted to sort of throw the challenge out there that if this is, that at least in a retirement sense, this is a new universe without a real peer risk, maybe this is our opportunity to break free of those sort of benchmark shackles that arguably are chaining us down. Because what we know about member preferences, and this is one of the few things that's absolutely certainty, is they have these asymmetric preferences. So the way we think about benchmark risk is that we define it in terms of standard deviation on either side of the mean, and that sort of mathematical concept doesn't differentiate between sort of upside versus downside standard deviation, and yet members care so much more about the downside than the upside. So this really is our opportunity to actually be true to that and create a solution that says, look, if the member doesn't care so much about underperforming in great markets, then let's actually have the courage to go there. But sort of one interesting sort of observation that's sort of a bit more practical is that when we launched defensive equities in the US just after the GFC, and we sort of launched it in this very innovative way because simply sort of those sort of bought protection strategies just fatigued clients and they sort of bailed out at the wrong time. We really launched the defensive equity at exactly the wrong time. We then saw exactly that, Stephen. We saw this huge sort of US market rally, and years in we thought, oh, this is, you know, a terrible time to have launched the strategy. And something really interesting came back to us, and that is that the more that the US equity markets came up, the more our clients were actually saying, thank goodness we have this protection, because they were just getting more and more worried that it was a bubble and it wasn't going to last. So it is very interesting that you might think that that's a horror period to run a defensive equity strategy, but potentially if it's like our US stakeholders, your stakeholders might actually be more pleased than ever that they have this protection because the bubble might be about to burst.
Thank you. Bev, I guess, you know, there's a couple of things that came out through your session. One is, I guess, you know, how do you, and this is a question that's come through from the floor, you know, how do you benchmark the amount that you're putting into alternatives? You know, are you benchmarking that against cash? Are you benchmarking it against the overall portfolio characteristics? But then also, you know, going beyond that, how do you then compare the benefits of using derivatives versus diversification?
I think you've got to look at the strategy of the fund and how much illiquidity it can take, what the total portfolio already looks like. Obviously, the answer would be very different for alternatives if the client had an 80-20 portfolio than if they were sort of 40-60. So I think it comes down to client preferences on illiquidity, what maximum illiquidity it would take, etc., as well as its desire for diversification. In terms of benchmarking, a whole range of approaches are taken because what I was talking about principally up there was opportunistic, which in fact is something that smaller funds can do. I think larger funds generally sort of go the siloed approach, but the opportunistic approach is something that plays to the strengths of smaller funds where they don't want to be in all asset classes at all times. We tend to take a cash plus with a minimum hurdle rate as a benchmark because the effect is on diversifying and not being a long-term exposure for that fund. So you look at it at the time you go into the fund, and obviously, and then when those monies are being repaid back, which they are, generally it'll be a 3-4 year investment period. Most monies come back around 6 years, say, or most monies are fully back by 6 years. So it's a constant refresh of ideas, being opportunistic. So we tend to use a cash plus with a minimum hurdle rate, and then it depends on whether the client's coming out of, whether it's viewing them as a total portfolio substitute, or whether it's viewing it as being funded out of equities or funded out of bonds. So it depends on the client and on how they're looking at it effectively. Yep. Some people just view defensive alternatives as in their part of their fixed income portfolio, view it as bond substitute. Other people would look at it in a total portfolio context, which I think makes more sort of sense, really, particularly a lot of infrastructure, which can be quite growthy and quite linked to GDP. So I think it depends.
Sounds good. Now, any other questions from the floor? As we said, that we do have roving microphones. Happy to take any other questions. Jim, there's someone's sort of thrown out a bit of a challenge to you about why you think the future is rather benign. Well, especially given the situation that we're in with debt levels and
Look, I'm not sure that I said that the world looks benign. I mean, compared to bonds, everything looks good. I think that's the point I was making, right? So, if you're in a world where you need to invest in safe assets, you know, and you've got, you know, things like capital preservation really matters to you, it's a really, really tough world. If you've got a choice, equities look good compared to bonds. Compared to their own history, equities, like many things, don't look that great. And I think the point I was making was that the sort of like the that a lot of these things give you above bonds is probably average or higher. So if you believe that bond yields are going to stay low for a long, long time, there is a potential where, you know, things just go crazy. I mean, I don't, it's not my central case, but I mean, it is possible that some of these liquid assets get really bid up a lot further.
Thank you. We've got one final question that's come up here before we wrap up, and I guess it's a challenge to Bev and others. The one asset class that seems likely to do well in the next 3 to 5 years is volatility, but it is a huge negative carry. What's the best way to take advantage of the volatility?
Yeah, well, I would say that that you generally want to be long vol rather than short vol, particularly if you look at the range, say, for the VIX, which is, you know, sort of like 8 to 80, and it's currently around 9.5 or something. So you generally want to be long vol rather than short vol. I think in terms of some of the, I think back in 1987 to the very sophisticated constant, or what were then very sophisticated constant proportion portfolio insurance strategies, and a lot of the back tests that worked then, and a lot of the work that was going on about momentum investing. When equities go up, you buy, and when equities come down, you sell, and all of that stuff. And I look at some of the strategies and volatility that I see around today and see a lot of parallels. So I think it's very difficult for trustees to find sort of a truly unique volatility strategy. I've seen some that have been invested in, but let me tell you, most of those people are generally spending 1.5 to 2 to 2.5% even per annum, you know, on protection, and then trying to find some upside as well. So, you know, volatility as a strategy, I think, is generally a drag. Particularly if you're using it in a protective environment, and occasionally you get some nuggets of upside. It's a really tough, good question, tough ask.
Can I just add, we've done some work on, so as you say, sort of the way that we run strategies is we're sitting on the sell side of volatility protection, but we have done a lot of work around implementation and the best types of instruments to use to take a volatility bet, and you're really looking at options, equity index options, you're looking at variance swaps, or you're looking at VIX futures. And in terms of the hierarchy, and I can sort of go into those for people afterwards if they want more detail, but sort of the hierarchy of preferences in our view would be to use option into equity options. Next most flexible or useful for an institutional portfolio would be the VIX futures, and the one that's really hardest to construct a targeted volatility portfolio is variance swaps. So there's a hierarchy for you.